This is the Train the Trainer on Whole Farm, and Shannon Antonini will be presenting today. And with that, I'm going to turn it over to Shannon, and we'll get this started.
Thank you, Shannon. Hopefully everyone can see my screen here.
Yes.
My name is Shannon oh, thank you. Oh, I just lost my control again. There we go. My name is Shannon Antonini, and I am a crop insurance agent based out of California with American AgCredit, servicing growers in California, Western Slope of Colorado, Oregon, Washington, and Hawaii. And today we're going to talk about whole farm revenue protection. What is it? How does it work? What are the features? What are the benefits? And what's it take to qualify for whole farm? So whole farm revenue protection is revenue for all of the commodities grown on the farm. As you are probably aware, there are crop insurance policies specific to individual commodities, but this would cover all commodities. So it provides an umbrella, if you will, protection over your revenue as opposed to guaranteeing tons of a specific commodity or pounds or whatever. It's covering the revenue. And it provides protection against loss of revenue due to insurable causes of loss during the insurance period. For a calendar year tax filer, that would be the calendar year. If you're a fiscal year filer, then it would follow your fiscal year. It follows your taxes. And it's any damage due to natural causes. So weather-related damage, pest, disease, wildlife, hurricanes, volcanic action. We've been dealing with a lot of fire here in California. All of those types of things are covered. We use the 5 years of average from the Schedule F tax returns. So there are a couple different ways we can calculate that average. There's the simple average. We just take that revenue and add up the 5 years, divide it by 5, and come up with that simple average. We also can index the revenue or do an expanding operation adjustment. And for an expanding operation adjustment, we have to show that there is a true expansion of the farm, whether that be newly obtained land that's been planted or planting a brand new crop that you've not grown before. There has to be an actual expansion. And then we also look at a current farm plan, and we take the 5-year average and the current farm plan, and the approved revenue would be the lower of the two. The guarantee is the coverage level multiplied by that, which is selected by the grower, multiplied by that approved revenue to come up with what the guaranteed revenue would be. In order to qualify for 80 and 85% level, which is the highest level, 85 is the highest level available, you have to show at least 3 different commodities that you're growing. So really this product is designed for a diversified farmer. The more commodities that you're growing, the higher that you can insure and the better the premium subsidies are. We also look at the average expenses on the Schedule F income, and that would show on the summary of coverage as well. If in a loss year you spent less than 70% of those average expenses, then there would be an adjustment to the payment based on that. Whole farm revenue does not cover any post-harvest production improvements. It doesn't cover ag tourism, custom farming. Any income that is not derived directly from growing the crop would not be covered and would be excluded on the policy. There are some limitations with whole farm. For livestock, you can only have a maximum of $2 million in revenue per year that would be insurable, and the same would go for nursery. And then the maximum insured revenue would be $8.5 million.
Hey, Shannon,
something to mention, sorry.
Shannon, on the last slide, when you said custom farming, what is you guys' definition of custom farming?
So if you are farming for someone else and charging a fee to farm that land, I'm trying to go back here. you're just charging a fee to do the farming of that land, but you have no financial benefit in the crop itself. That would be the custom farming.
Thank you. I wanted to make sure that your definition was what I was familiar with. Thank you.
Yeah. Also to mention here, if you don't have at least 3 qualifying commodities, you can still have a whole farm policy, but the maximum revenue that you would be able to guarantee would be 75%. Okay, so really the benefits of the whole farm policy is it covers the revenue on crops where there isn't a traditional crop insurance policy available. So it provides that protection for you. It does allow you to maintain your current MPCI coverage, multi-peril crop insurance. So that would be the traditional crop insurance policies. You can have that policy and have the whole farm revenue. You actually receive premium discounts if you do have both policies because you've split the liability. It is farm level protection. So we use your expected prices, not a regional price or a national price. If you have contracts in place, that's the preferred method to calculate your expected revenue. There's a very detailed list of ways that we can come up with those expected prices. And it allows people to, if you have MPCI coverage also, it provides some flexibility in that maybe you don't insure your coffee at the 85% level, you insure it at 75%, but you still are maintaining protection all the way up to 85 because you are diversified and have more than 3 different commodities. So you're protecting some of that revenue on the whole farm policy as well. One thing with whole farm is that in the event of a loss, losses aren't paid out until after the taxes are filed for that crop year. So with a traditional crop insurance policy, you're paid out your losses once you harvest. With whole farm, you've got to wait until after you file your taxes for that tax year before a claim would be adjusted. So in order to set up a policy and what we need as supporting documentation, we would need 5 years of Schedule F from the 1040. For 2021 crop year, that would mean 2015 through 2019. We would need a farm operation report, which basically we take the acres that you have planted or intend to plant for 2021, and then also the expected yields from those acres and the expected price. To come up with an expected farm operation report, we do have a mid-year reporting, I believe July 15th, the deadline for that, where we take a look at what you reported as your initial farm operation. Maybe you didn't get something planted, you changed your mind, whatever. We can make adjustments at that revised farm operation report at that time. And then at the end of the crop year, we do a final farm operation report where we report what you actually did farm and what you received. That's kind of the overview of whole farm revenue. It's a pretty detailed program, but it's kind of one of those where you either do the overview or get way down in the weeds. I would love to answer your questions if there are any.
Okay, well, I kind of have a question, and I think it circles back to sort of Jennifer's maybe potentially back to that slide. Since it does cover like a diverse series of crops, and you said where is the crop, like the list of crops that are covered in whole farm insurance? But then you also mentioned there was a way to get ones that were not listed covered. And since Hawaii has so many specialty crops, and most people have like, at least a lot of the people I've worked with, and someone can correct me if I'm wrong, have really diverse operations. So like, what are their options if, let's say, the majority of the crops they have are not covered on this list? So it sounds like there's a potential option, but I wasn't quite sure.
The list is very extensive. I can download a copy of it and email it to you to go out with that that sheet that I already sent you. But
that'd be great.
There's a limited number of crops where you can buy a traditional crop insurance policy. You've got your coffee, banana, papaya, there's one more.
MacNut.
Oh, MacNuts, sorry. Those are the 4 traditional policies. Outside of that, I mean, crop insurance has a whole lot of other crops that are insurable, but they're not named crops in Hawaii. So the whole farm could potentially cover those other crops along with the unique crops that Hawaii has. I've yet to hear of a crop not being insurable under the whole farm policy, because there actually is a general other fruits, other vegetables. There's even just a category that's other crops.
Oh, okay,
So
that's nice.
most likely we could fit it into something.
Thank you.
Shannon, I had a question about farms that either vertically integrate, say they have a farm stand, or they might do some processing with their crop. How would those prices or those be handled by this policy?
I have asked that question specific to coffee, right? Because the price that Whole Farm is looking for is actually the cherry price, not the roasted bean price that is being sold at a farm stand. And according to the policy, post-harvest production costs are not covered, but being vertically integrated, you're not going to have another price. And I've yet to get a straight answer on it. I just actually sent an email last week again. I've been asking the question since November. So I don't have an answer for you, Stuart, unfortunately, but it's something that I am working on. And if I can get a straight answer, I would be happy to push that out.
Great. Because I guess related to that would be, say it's a vegetable grower and they're selling it at a roadside stand versus to a wholesaler. So
yeah,
similar kind of situation.
Well, similar but different, because with a vegetable stand, more than likely you're not going to have a post-harvest improvement to that vegetable, right?
Depending. I mean,
Okay.
I guess I'm pushing for, say, something like, say you were a guava grower and you're doing guava jam, or a vegetable and you turn it into a salad, perhaps.
Okay,
Yes.
so that's where we get into that area where I can't get an answer, because the whole farm covers the cost of producing that crop, but in the instance of the jam, it wouldn't cover the cost that you incur in taking that guava and making jam out of it. Your time, labor, packaging, all of that. And what you report on the Schedule F is probably that final revenue. When you actually sell it, you don't have something to report that would just be for the growing of the crop itself, correct?
Yeah.
Yeah.
Well, please let us know when you find out. That's I think for most, like you're saying, the majority of the crops here, that could be an issue if they're not, just because a lot of folks don't sell straight to a wholesale area or to somebody else.
Right. Right.
So I have a question kind of to follow up to that. This is Jennifer. I'm wondering if the coverage is only until the crop leaves the field. Since you just said that about the value. Okay.
Yeah, it wouldn't cover crop in storage. It's crop insurance and whole farm revenue is the crop itself as it's growing.
Shannon, this is Andrea. Does whole farm cover livestock and produce on a farm? I do have some farmers that produce lamb as well as crops. Does it cover both under one policy?
Andrea, I got part of that. I didn't get the whole thing because you cut out there, but if I understand based on what I heard, you're asking if the lamb would be covered along with the other crop, and that's what I missed. And yes, it would. Livestock does have up to a $2 million revenue limit on whole farm. So it would only, if you exceeded that $2 million in livestock revenue, the additional would be excluded.
And it would be on one policy, or would the grower need to get two policies for livestock?
No, it's one policy because whole farm is following the tax ID number. It's the revenue for the entire farm.
Thank you.
Do we have any other questions? I did forward to Shannon. It looks like actually she put it up there in the chat box, but there is a, it's just kind of an overview of whole farm, a handout that you can utilize. I'm happy to answer questions at any time. Feel free to email me, call me. It's my cell phone number. You can text me.
I have a
happy to go over.
Shannon. This is the other Shannon.
Mm-hmm.
So I know you said it takes like 5 years, but we had kind of talked about newer farmers. Is that like different for newer farmers versus like, because you know, I mean, you're a pretty established farm if you have 5 years worth of tax returns at this point. So
yes, so beginning farmers can provide, you have to provide at least 3 years of Schedule F. Excuse me. So a beginning farmer could provide 3 years, and we could set up a policy based on that. And beginning farmers actually do qualify for a discount as well, and that would be for their first 10 years of farming. So there are special accommodations also for beginning farmers, besides just
nice.
fewer years of tax returns.
Nice.
Besides the Schedule F, is there any other information that's needed from the side of the farmer in order to apply?
Well, that farm operation report would need to be completed. The application itself is mostly just entity information, and everything really comes off the Schedule F. If there's any prepaid expenses or accounts receivables expected in the next crop year, then we would want to report those. So we'd need to list out those. But that's really about it.
This is Stuart again. You had mentioned a farm plan. Would you have an example of that? You know, I guess some people think it's just a map and others go beyond that. So
yes, if you give me just a second here, I can pull one up. And I should mention too, while there are only those 4 established crops that are insurable in Hawaii, there are a lot of other crops with traditional policies that could potentially be insurable in Hawaii. It does take a little more work on the part of the agent to do that, but we can insure by written agreement. So if you have growers, you know, growing onions or potatoes or something like that, there's potential to get those insured as well. This is the farm operation report that we use. So as you can see here, I mean, this would be the year that we're establishing the coverage, the commodity code. So that's where we would put what type of crop it is. What's your method of measurement? Is it acres? Is this, if it's livestock, we would put how many head, that type of thing. Your yield per unit of measure. So over here, we've got the unit of measure, whether you're using pounds, boxes, tons, some standard unit of measure. And then this would be the production for that unit. Your expected value, that's what I was talking about, coming up with those expected prices. That's what we would put there. And then we would multiply that out to get the expected revenue. The total number of head or acres, and then that would come up with our expected revenue right here. So this is what we would provide up front, would be, if you can see my cursor going down here, anything to the left would be done up front. In July, we would do the revised, which would be this middle section. And then at the end of the crop year, we would do the final, which would be the actual production and the actual revenue received from each of those crops. If you're growing a perennial crop, so a tree crop, you would also have to do, we would need to do a producer's, it's called the producer's pre-acceptance worksheet, but it's just the planting. When was it planted? How many acres? What's the spacing? That type of thing.
Shannon, I had a quick question. This is Emily from Kauai. At the beginning, you mentioned that damage due to natural causes, including pest and disease, was covered. I was wondering if there are any limitations on pests and diseases that would be covered.
I know that for the individual policies, there are some limitations to some of the pests, but on whole farm, that's a really good question. We're guaranteeing the revenue, not the production. I would have to get confirmation, but my gut tells me that it would be covered here because we're just looking at dollars here. But I can confirm that, Emily.
Yeah, I'm thinking we often have we have a lot of wildlife problems, so I'm thinking about that's something that could cause significant revenue loss in a given year, and just want to make sure that some of those major causes of loss are likely to be covered.
Okay.
Emily, that's
Just
actually
writing a quick note.
Because if there's already an established protocol for managing a pest and the farmer neglects to implement those recommendations, if it would be covered or not. So that'd be good to find out, Shannon, if possible.
Yes, and just following suit with the traditional crop insurance, if good farming practices are required. Now, the definition of good farming practices is a little bit vague, but if it's, if you get a pest infestation and you choose not to try and control it, I do believe the claim would be denied because they are going to ask to see, did you apply any pesticides, or if you're an organic farmer, did you apply the approved farming practices that would mitigate losses from that pest. So you do have to show that you were making an attempt. But I can get more clarification on that. I mean, you have to be farming it though. You can't just, if you walk away from it, then that would not be covered.
Well, I thank you so much, Shannon, for your presentation. I just wanted to remind everybody who's participating to please help us fill out the evaluation survey for this, as well as the previous webinar that we had. If you haven't done so already, I will send everybody an email with the link. And also the link is in the chat, as well as for the website that we have for these trainings. And so you can search that website for the different resources, as well as we'll be posting the recorded videos online there. And if you guys have any questions about any of these webinars or the program, please feel free to contact Shannon or Stuart or myself. But thank you, everybody. And Shannon, I'll take it back to you.
So with that, if nobody has any additional questions, thank you for your time, Shannon. We really appreciate it. And hopefully we will see most of y'all next week for our presentation on crop insurance. I believe that's next week. So yeah. So with that, have a good rest of your lunch hour and thank you for joining us. Bye.